The cryptocurrency market has lost over $2 trillion in value since reaching its height in 2021. Shark Tank investor Kevin OLeary, aka Mr. Wonderful, believes the worst is yet to come. In a recent tweet, he states, "There's going to be total panic and massive volatility in the crypto markets ahead before the industry swings back towards stronger firms and clearer regulations." The crypto market reached $3 trillion in November 2021. Since then, the market has dropped by over 60% to about $920 billion, its worst first half year ever. The crypto market's collapse has resulted in numerous crypto funds and platforms going under. Thousands of people have been laid off. Coinbase last month laid off almost a fifth of its workforce, 1,180 employees. Gemini, Crypto.com, BlockFi, Panda, and OpenSea have all cut 5% to 20% of their workforces, with more anticipated to follow. Crypto firms Celsius Network, Voyager Digital, and crypto fund Three Arrows Capital all declared bankruptcy last month. OLeary states that despite the huge losses, the worst is yet to come. He believes there will continue to be tremendous selling pressure. This will trigger total panic among investors, and more weak crypto companies run by idiot managers will be weeded out. Kevin OLeary believes that only after a real big event will the crypto market hit bottom and the industry will begin to swing back towards stronger firms and clearer regulations. In a new interview on the Stansberry Research channel with Daniela, Kevin OLeary shares more insights into the crypto market. Before we listen to him, please don't forget to smash the like button and subscribe to the channel if you are yet to do so. Thanks for watching our videos.
I see Bitcoin sort of testing 20,000 all the time, getting a lot of resistance there, seems to be holding the 2023 area. Still very profitable for Bitcoin miners that are currently mining at about 7,000 per coin at scale. And so there has been a knee-jerk reaction against Bitcoin miners lately because of ESG concerns, but they're also self-correcting by getting into nuclear and hydropower, which is plentiful in some countries like Norway. Now, crypto itself desperately needs policy. It needs regulation. And there was a bill just 2 weeks ago that was contemplated being pushed through, not on Bitcoin, just stable coins as payment systems. And as you know, that's been a very volatile area. That bill, that initiative has been stalled till September, but I think there's a 50-50 chance that we will have policy on basically stable coins tied to the US dollar. And let me explain specifically why I think it's going to happen. There is a turf war going on between the SEC and every other regulator as regards to crypto, NFTs, tokens, all of this stuff. And so the smart regulators, the policymakers are saying, well, wait a second, let's pick one outcome. Let's just do payment systems, just like a credit card, a Visa card, or a money market fund, which has very limited flexibility in terms of what you can hold in it, basically T-bills and dollar for dollar cash. Same thing with a payment system like a stable coin. If that policy comes down, let's say it gets done in September, that's a signal to the market that we're starting to break open the logjam on policy making. And I'm very, very optimistic. In fact, on August 3rd, I'll be addressing the bipartisan legislature in Colorado on specifically in Denver on this issue. Very rare to get all of the policymakers in one room, both sides of the aisle and their staff. This is what they want to talk about, the digital economy and policy on digital currency. I'm one of the people going there to address them. I'm very proud to be doing it. But the point is they want policy. We're finally getting something to happen here, I think.
Yeah, and I know you've been saying this for a very long time, but specific to your holdings, Kevin, what's been your personal strategy with the cryptos with this down period we're in? Have you been adding to your position? Have you stopped? Are you good with what you have? What's your take?
No, we took a hit. We were at 20, and then it grew up to 23%. Then it went down to 16% of the portfolio. I mean, it was really volatile. But I've always said you're going to get this volatility in an ASN industry that's not regulated because there's no institutional bid. So probably at the low, we're at 15%. We lost, 40% of the value. And now we've come back up on some projects, and they haven't all come back at the same pace. The big players, the big market cap names like Bitcoin, like Ethereum, like Solana, like Polygon, HBAR, in some cases we doubled down. We took advantage of the extreme volatility in the large cap names like ETH and like Bitcoin. Why not add to the position if you're going to stay long? But everybody trying to manage this space, I don't care who you are, if you tell me you made money in the last 90 days, I know you're lying. You've lost money and you're just averaging down, hoping for this to climb back up. if you'd owned these positions for more than 2 years, you're basically in a break-even situation. So this asset class is not correlated with anything, as people thought. It's not correlated with inflation yet, but the real problem, and every time you and I talk about this, it's really a gauge on where the institutional buyer is. And right now, zero. They have no Bitcoin. Anybody that tells you the institutions, the sovereigns own it, is full of poo-poo.
You know, when are we going to hit peak inflation, Kevin? Have we?
Well, we haven't yet, particularly if this Build Back Better bill prints another $400 to $600 billion and flushes it right into the economy. That's probably not going to be a good outcome for inflation because it's very inflationary, even though it's trying to be labeled as an anti-inflation bill. Anytime you print money, you get inflation. So we'll see what happens. That's got to go through the gauntlet in Washington. That's one factor. The other that's really interesting that has a lot of market watchers really scratching their heads right now because it's never happened before. You've got a situation of full employment that's like 3.4%, and yet at the same time a second quarter of GDP shrinking. That has never happened before. So one way to interpret that is to say the productivity of the 2+ million new workers that have just been booked into the economy must be very, very low. Or maybe they're not really working 8 hours. Maybe they're working less, but there's something not working to the traditional model, which is why I think it's giving Powell pause, because he has been job owning a more dovish Fed, having just done the 75 basis points. Even he doesn't know what's happening here. So he's data dependent. We've never seen this before. Never in the history of the economy in 200+ years has this ever occurred. So again, another sign that is not fitting with what everybody wants towards this recession, maybe.
Okay, and you say towards this recession. So I know there's a debate out there of whether we're in it or not. I'm assuming for you, we're not in it yet?
Well, the narrative towards the soft landing has changed so much in the last 8 weeks because just 2 months ago, nobody thought Powell could engineer anything like this. Yeah. And here we are. It's very hard to call this a recession when you've got full employment. And so is this working? So at least 50% of the pundits or the market now believes a soft landing is possible. And again, a lesson learned for everybody who thinks they can time the market is, look what happened in July. You've got maybe half of this year's returns came in 4 days. And so if you weren't in the market, you didn't capture that upside. And so it's impossible to time the market. You would have never guessed July would have been a good month, but it was.
You know, help us decipher this because like you said, you know, we're getting this relief rally, but is it giving us a false sense of optimism, of hope? What's the truth?
Well, the truth is in the earnings. And so far, everybody was waiting to see earnings completely blow up. Didn't happen. Many companies delivered, even the highly speculative tech companies, and we're more than halfway through earnings season, and it looks pretty good. Now, it's not as good as it was a year ago, but it's nowhere near as bad as everybody was forecasting that we would be in the height of a recession right now, and we're not. And so this is a very difficult time to make a decision between fixed income and equities because, as you mentioned earlier in the show, we've got an inverted yield curve that's generally never good. But again, when you can't tell me why we have full employment, 2.5 more million people working, and low productivity, then maybe you want to be a little careful about making more decisions about raising rates or changing policy or raising taxes. They all sound like really bad ideas until you've really figured out the riddle of what's going on in this economy. We don't know.
Exactly.
So my attitude is to stay long equities, continue at a 30% weighting in fixed income. That's very low for me. Usually it's 50%. And just wait and see what happens.
On the face of it, it seems inflation could be approaching a crisis. If inflation keeps rising, that would be a bigger problem than the one we already see. All told, there's not enough relief in sight for inflation just yet, and certainly not enough for the Fed to back off anytime soon. In fact, even with a sharp retreat in gasoline prices in July, we still look for headline inflation to hold close to 9% year over year in the summer, before relenting somewhat later this year. The risk for policymakers is that the longer such media readings fester and affect wages and consumer psychology, the tougher it will be to crack expectations. Finally, getting past the peak of inflation is just the start of the job for central banks. After all, if inflation peaks but then eventually settles around, say, 5%, then the job is only half done. What do you think of Kelvin OLeary interview? Let us know in the comments. Thanks for watching.